Hey everybody, it's Scott. I'd like to talk about something that everyone's talking about, everyone's scared about, and there's a lot going on of uncertainty right now in our markets. Um, One big deal is the ugly I word, or inflation. The idea that the price of something, your dollars are not going to buy the same amount of something as they were prior to the crisis. Now, the most recent sort of time where everyone typically goes back to is the 1980s, which may not be a time in history you're aware of, but our parents or your parents' parents may have experienced lines at the gas station or embargoes where things are not flowing from one country to another. Now, we do have supply chain shortages where items are not being brought up or created and shipped as easily as they were. However, our crisis is more about an unintentional one than an intentional one. Note, there were more than one crisis going on in the 80s. There was quite a few things that stack up. And it is important to realize, even though the pandemic is over, we have no lack of potential options for crises and uh, possible inflation triggers. Just about anything that reduces our supply or increases our demand uh, without necessarily having the supply can lead to inflation. So I wanted to go just show you a couple of things. Uh, this is the S&P 500 uh, compared to housing prices, so home prices. So even though you see the S&P 500's been going up, real estate's been going up, you see a constant up and to the right. Now, if you look, the Federal Reserve, actually puts out and uses these numbers. So there is some part of their calculation that must care about these. This is a government website that actually is being used. And if you look, there are times where the ratio continues to move up, and then there are times, such as the 2008 crisis, housing went, and also the S&P went at the same time. Um, but essentially, the S&P slid even further than housing in some cases. And it took a number of years before prices returned back to anything past normal. Um, Plus, now we're in a point where everyone is trying to fix their house and get something out of it. So we're seeing that we're at a absolute new high. We don't see any shape to this yet, so there's no seeming curve over yet. But remember, uh, we've seen times where even though after a recession or a short recession, it continues up. This was the dot-com bubble, which really wasn't a big thing for real estate as much as it was for stocks that had no earnings or income. Essentially, these companies were just pieces of paper that weren't producing enough or anything and probably weren't for some time. Didn't mean they were completely worthless. Amazon's one of those, Google's one of those that made it back out. But just seeing that we are at these all-time highs. Likewise, we have a composite of 20 cities. These are things like San Francisco and California and Houston, Dallas, big big metropolitan areas, and we also see all-time high, higher than even 2006 and 7, when prices were extremely high and buying a house was assured to go up supposedly as anything could ever be. Houses only go up was the saying, and that absolutely was not true. Uh, Houses dropped in half and sometimes even worse for some people. They were given housing loans to virtually anyone, regardless of whether or not you had an income, known as a ninja loan, no income, no job, and yet you still somehow got a loan. So seeing this new time high uh, is concerning. However, we also can look for other types of inflation or inflationary items such as the cost of commodities. So this is the cost of many of the things that go into building the things that companies use to make those end products. This is just food. Just year to date, we're looking at, there's a few things that are down. Orange juice, that's not much. But lumber, oh my God, look at that, 84%. Now, that may be in part because the housing, maybe in part because of supply chain needs and just people weren't out logging the way that they were. It is interesting that this isn't exactly across the board. So there are some things that definitely went up and some things that didn't go up as much as you would think. Just recently, corn has shot up, and corn is in virtually everything now, as well as it's an input through ethanol and gasoline. So that may actually raise some of the price of gas as well. We see beef, that hasn't really moved. Now, hogs, which basically is pigs, have moved significantly. One of the main consumers of uh, pigs is actually China. So their demand for pig over beef is actually substantial. So they in many cases move that market. Now you see other uh, metals and from precious metals to just industrial metals, especially copper. This is in virtually every wire, every circuit board that you have. And then lithium with the electronic vehicle push. There has been a huge push in lithium. Um, Now, this may eventually, years from now, if they close loop recycle lithium, you're going to find it's going to be more like aluminum, where aluminum's actually extremely rare, but since it's readily recycled, the price is fairly controlled. Lithium likely will end up in that category if it's going to be used for mass uh, transit or let's say for your battery for your home or solar. If we're going that way, it's not going to be practical unless it's recyclable. So those that are sitting on a lithium gold mine may find out that it's not as much of a gold mine as they thought. We have a few other commodities that have moved up, but these aren't insane numbers. Insane numbers are things like Venezuela and the actual currency of Venezuela, which when you talk about inflation, inflation really is another way of viewing it is the exchange rates between other countries. For example, the United States doesn't produce um, as many things as many times as it consumes, but we do produce quite a few services. So even though you may not see a lot of product ships or ships flying across the ocean away from us, we do provide a lot of services. So if we look for, there's many different currencies, but essentially the Brazilian real. Uh, Russia's an interesting one because there you can actually see they've not necessarily done as well in the pandemic either, although they may never actually claim that. You can see how right here the ratio of one US dollar to a ruble has definitely went up since the pandemic started here, uh, from 60 to 70 to 1. So there's definitely an increase there. We know countries like Mexico, they did have issues. They are part of the North American Free Trade group, which likely will mean they're bound to end up with vaccinations or more vaccinations. Similarly with Canada, any U.S. trading partners are likely to end up start getting vaccinations, um, as the U.S. finds that it's identified the majority of its usage is done. They're going to want to start pushing those vaccines to many other places in the world. And you see we're back to basically our 20 to 1, which it was definitely higher earlier on here, um, but it's actually went down quite a bit. It was 18, and then you see it fly up to 25 or near 25 to 1, and now back down to 20, which for the most part it's hit before in the past, but is nowhere near where it was during the pandemic. So that they have things fairly under control. And these are countries that don't necessarily peg their currency perfectly to the US dollar. They are free floating. You can see something like China where they're more likely to peg to the US dollar because they are trading partners, and essentially we buy lots and lots of things from them. You don't see a lot of jitter, but even uh, during the pandemic, right in the February time frame, you can see there was a little bit of change, but definitely way more change afterwards here. Um, but it's still fairly stable. As you can see, they can hold their currency rather stable and then they control it down. It's slightly more free floating right now, but they have an ability to completely control the exchange rate, which is not something the United States tends to do as much. We don't uh, use our exchange rate as much as we tend to control our interest rates. So seeing all these numbers, essentially you see there is definitely inflation. Is it hyperinflation? I wouldn't claim that there's hyperinflation anywhere in the United States. And as long as the economy is still open, um, it is unlikely that we are going to have hyperinflation. Hyperinflation tends to happen um, when you have a country that's basically in a failed state. It's where the country no longer is willing to or is going to pay uh, the bills to other countries. It basically ruins your credit. It would be equivalent to an individual saying, "I'm not going to pay you back." And at some point here, as you can tell, even this list doesn't even make sense because they stopped reporting. So as you can see, it just doesn't make any sense anymore. Their inflation was off the chart, um, thousands of percent. There were people in Venezuela that were using Bitcoin as their stable currency. And Bitcoin by no means is a stable currency, but relative to Venezuelan Bolivar, it was definitely more stable. So you have to think that is not where we are today in the United States. It's not impossible, but in order for that to happen, we're talking about the complete implosion of our government. And even if the government decides to raise the tax rates, which they definitely have, right? There's uh, Biden tax rates, which have absolutely sound scary, face up to 61%, tax rate, which sounds bad, but it's been done before. Historically, the United States tax rates have been up that high before, and it's important to remember that this is used more as a lever to push money in different directions. Right now, we see our housing is up. We see um, what we see that our housing is up. We see that our stock market is up, and essentially we've put tons of money into the economy to patch the hole that was created by the pandemic. There were no more goods and services created. There was nothing new that got created. So the question is, as the tax rate, moves along here, and we see that it's been all the way up to 90 some percent, which sounds insane. Um, Remember that we are under a tiered tax system. It doesn't mean that everyone pays 90%. It means that on the first, second, third grouping or whatnot of income, you pay a certain max tax rate of up to 90%. And we've been dropping this tax rate, recently, substantially. And there are other countries that have low tax rates. But something to think about is when you have a high tax rate, it means you're more likely to find tax shelters. You're more likely, in this case, to maybe buy real estate, put money into things that may not be as productive, which may not be what you actually want to do. You may want to drive business and not just drive buildings. Now, with low interest rates, it may make perfect sense to go build buildings right now. But once they jack up the interest rates, you'll find that it may be less likely to get borrowed money. So they need to somehow soften the blow to real estate. And one way of doing that is upping the tax rate, which makes those look like a better tax shelter, while at the same time moving the actual interest rate for mortgages up, reducing the demand for mortgages. So they're playing a balancing game between those two things. So that being said, in summary, there may be inflation, but there are levers to control the inflation that we're going to get. We are not in a failed state. We are not Venezuela. Anyone that says it's all going to crash, they are likely going to benefit some, but not benefit from the power engine, which is the United States, and the likelihood for especially growth companies to come back and ultimately outperform any type of physical asset that you have.